welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning to all of our viewers and our listeners out there. It is Tuesday. We are back here again. I am Barry Saywitz, president of the Saywitz Company, managing partner of Saywitz Properties. And if it's one thing I've learned in my 30-plus years, actually, I have to say 35-plus years because I'm old now. I was looking at my own resume, and it's got a 3.5 in there. But if there's one thing that I've learned, it's that you try and surround yourself with smart people. You try and get good advice. You try and make good decisions and try and stay out of your own way. And so we're going to try and do all of those things this morning, and we're going to talk a little bit of real estate along the way. And so before we get going, I do want to do a couple of shout outs. Number one, it is October 1st, so we are in the fourth quarter. For those of you who have been listening all year and thought, geez, I'll never make it to the fourth quarter, guess what? You're here. And we are closing in on the end of the year, good or bad, and it's an interesting time. We do have lots going on in the world, political-wise. We have an election coming up. We have multiple wars, skirmishes, all kinds of dramatic stuff. But on a positive note, I do want to do a plug for the Evening for Autism party that we are hosting at my home in Newport Beach, California on Saturday, November 2nd. We expect a guest list of more than 400 people with 3 live bands, 7 restaurants, 7 bars, all kinds of special presentations and fun stuff. It's a tropical themed extravaganza, I think is what they're calling it. And so you can get tickets. Please go online if you're interested. There are a limited amount of tickets still available. It's www.evening4autismsocal.com. So with all of that said, I want to welcome our guest, Eric Paulsen, regional president of Mathews commercial brokerage company, back to the show because it's you've been here before, one of the few that we've invited back, and so glad to have you.
Yeah, glad to be here.
And so I was looking
made the
at,
cut.
yeah, you did, and we need to do an update because the last time you were here, it was about 18 months ago.
Mm-hmm.
The world was in a different place, the markets were in a different place, and then you blink and then you wake up and you're older and grayer, and the markets have shifted, and now we got new stuff going on. So I wanted to have you come back and we'll talk about what you're seeing in your perspectives on the different aspects of the commercial market.
Absolutely. Glad I'm here. Thanks.
So you were telling me earlier there's some new laws, especially in California, that are really restrictive and are going to, I believe, highly impact what happens going forward on the commercial real estate markets. There's all kinds of other laws and propositions that are on the ballot as well in November that are going to impact things. But I guess talk about what you're seeing in the recent laws that have come into play.
Yeah, no, happy to. So my day job is with Mathews. My night job is I'm the president of NAIOP SoCal, and we're heavily involved in tracking legislative affairs. We've got a couple of PACs that track everything. And unfortunately, we kind of got a couple of gut punches. And when I say we, I mean the commercial real estate industry. AB 98 was a gut and amend bill where we thought it had died for the year, and then it came back later. It was put on the floor at 11:36 without discussion and voted on before the midnight deadline. We were hoping that Governor Newsom would veto it, and unfortunately he signed it. Now, AB 98 is going to impact industrial real estate throughout California. It's a statewide mandate, so it's not any particular city. It has design, building standards and codes. It has setbacks of up to, I'd heard this morning that they were talking about 900, but my understanding was 300 to 500 feet from a sensitive receptor, which is basically anything that breathes oxygen. They're going to have to redo all their truck routes, so trucks are not going to be allowed to drive on residential streets. They'll have to be zero emission by 2030. And in some areas, they've been taking down homes to build industrial in the area. Well, if you take down one home, you're going to have to replace it with 2.
Crazy.
So it's making it so it's not feasible for new development. Some companies will benefit from this because they have either ag land all around them or they're not completely built out. But the real beneficiaries will obviously be the folks who own industrial right now because you're not really going to see more supply come in. So the effort was to try and climate control and make certain that emissions aren't impacting neighborhoods. But it really is going to turn into a consumer tax at the end of the day. We're all going to be paying for higher prices, if you're the only industrial in town, supply demand means your rent's going up and that gets passed on.
Right. I mean, at the end of the day, the consumer's really just paying for it. People
Always.
don't understand. They think, oh, yeah, this is a good thing. Then I won't have an industrial building close to my house. And then the odds of that happening in the first place were slim and none. And then what are the odds that you're going to pay more? It's almost certain.
Right. And you're now going to see trucks having to drive further. So it's, at the end of the day, it's intentions were probably good. At the end of the day, you think there's some good intentions behind it, but the cause and effect. And unfortunately, when you talk to some of those that voted for it, they don't understand what the ramifications are. So we were hoping for a big education push to help people figure this out, the congressmen, the senators that all see these bills. But what you'll find out is that 80% of all California politicians have never held a private sector job. So
either don't know or don't care, right? Or both.
yeah. Well, and if you have a career politician and the person pushing the bill or authoring the bill is the Speaker of the House,
Yes.
you want any money for your reelection campaign, guess where you're voting?
Right.
So unfortunately, you're starting to see not so much voting for the better good, but voting for their careers,
Right.
which is also unfortunate.
And if you look at areas, and I'll just pick an area, but if you look at Beaumont out further east, where there's lots of land and less impactment from a development standpoint versus an infill area in Orange County or Los Angeles, it makes it almost impossible to comply with the setbacks and all the requirements that you're talking about.
Exactly. So you will see developers probably looking elsewhere.
Yeah.
Now, there is some room for obsolete buildings where they're going to allow it, but my favorite part is we've passed this bill, but we know it's so flawed we're going to have to address it again next year and tighten it up.
In the meantime, you just put the brakes on everything.
Yeah, exactly. So to me, logic would have been for Governor Newsom to say, look, you didn't give the constituents a chance to talk about this. You crammed it through. You surprised everybody with it. Kick it back. Let it go through the commissions. Let it go through the committees. Let people get their bites at it. Have a bill come to me that's ready to go, not this flawed, and then we'll fix it later. And we're seeing that happening more and more often.
And the spin on it is it's good for the environment.
Yeah, exactly. Well, we're all climate warriors.
Right.
That's the other part of it. But
Which is fine, except you didn't really.
yeah, I'm not sure that
Do
at
your
the end
homework.
result it'll happen that way. So that's one example of what we're seeing legislatively. Two, that's a bill now, a law now, because it did pass, was 1103, and that was by Menjivar. And this is a bill where the good intentions were to protect small tenants, nonprofits, non-speakers of English at the end of the day. So ESL, if you will, where English is their second language. This bill requires that every document that is going to be official is translated into the primary language of the tenant or the nonprofit. So it has to be either Korean, Mandarin, Vietnamese, Taiwanese, or even Tagalog. So if that's their primary language, you now have to convert all of your documents that are official into their primary language. And if there's a mistake in that translation, so let's say Google Translate messes it up or your attorney or whatever, they can cancel it, no penalties. That's one.
Crazy.
The scary part about it is at one point they said you can only have 1 month of deposit on a commercial building. We've seen this on residential.
Yeah.
Right, but they're trying to put that on commercial. That got removed through all the dialogue back and forth as, look, that's not feasible. But what you're going to see is that the author of both these bills I've mentioned have said, this is a great start. We're going to crank
Right, we're
down
gonna
even
keep,
further.
right.
It's so much easier to tighten up language that's already a bill than it is to start scratch from there. So both of the bill's authors have come back saying, all right, let's get going
Right,
now.
that's step one.
That's a good start.
Yeah.
Now let's get going.
Also craziness because I now need to invest apparently in some translation software.
Yeah, exactly. Well, and again, the best intentions were to help these people who might not have understood a clause in the contract or anything along those lines, or not understood that, hey, when the expenses do go up, you have to pay those expenses, because one of the other clauses is you cannot have your expenses pop up on them without enough warning or without going into the next year. So emergency repairs, things like that are going to get eliminated. So they're trying to protect them, but at the end of the day, I think it will hurt them, because now I'm going to have to charge you extra rent for the translation because I'm not going to pay for that cost. And I may not do the deal with you in the first place if there's too many hurdles for me to have to jump through. And so I can see them tightening up, saying, thou hast to.
Right.
It's
Or could you have them sign a waiver that says I waive the right to have it in my own language? And
Well,
is that an option?
I'm going to guess it's not an option, because at the end of the day, that'll be a lawsuit.
Yeah.
You'll turn around and say, yeah, I signed that waiver, but guess what? I'm not
made me
allowed
do
to.
it, right.
You made me. I was forced into it. It's just an attorney's problem.
Craziness.
Yeah.
So you combine that with the port just shut down on the East Coast, right? This happened yesterday. You got Israel attacking Lebanon. You've still got stuff in Ukraine. You've got an election coming up. You've got interest rates came down a week or so ago, but that was already baked into everybody's thinking, and it's not enough. And then you have many, many things going on in the world that impact what happens on the commercial real estate side of things.
All of it does.
So from a day-to-day standpoint. And then you still have to combine that, I think, with the supply-demand, model, right? I mean, you still are back to supply-demand at the end of the day, but you have all this other stuff sort of lumped on top of your decision-making. So I guess let's dig in a little bit. So let's start with the industrial, since we were talking about it. If we rewind to when you were here last time, industrial couldn't have been hotter, at the pinnacle of where it was from a price per square foot, from a sales standpoint and from a leasing standpoint. Almost no concessions. Landlord 99% in control, multiple offers, multiple bidders, multiple prospects for space. And where are we today?
We are not there.
Yeah, we've moved a little, right?
Yeah, and it's all about the leverage, who has the leverage, and supply demand does dictate who has the leverage. And 18 months ago, it was the landlord. There was not a lot of product. You had a lot of tenant demand. Everybody was following up on the COVID boom of let's get as much product into the country as we possibly can, because there's a big consumer push. Now it's slowed down a little bit. You're seeing the port strikes. You're seeing a lot of issues to the supply chain. You're also seeing more and more, again, back to our legislation against some of these small business owners that have dictated that they'll move out of state just to be able to run their business. It got so expensive, businesses were deciding, do I even stay in business?
Yeah.
So you were seeing a 50,000 square footer going down to 15,000 square feet just to stay in business, because it was so expensive to run his business. Nowadays, though, depending upon the size of the building, I think when you look at anything from the 100,000 square feet to the 300,000 square feet, it's wide open. That business has been really impacted. Yeah, you've got a lot of options. Rents were 50 cents, then they went up to $1.75. Now you're seeing them back down to $1.25. Still up from the 50. Don't get me wrong; it's still very profitable for an owner, but you're seeing it not as dramatic as it used to be. But you look at the million square footers, and it's very, very tight here. Flip that over to Arizona, it's the opposite. They've got between that 100 and 300,000 square footer, you can't really find a lot of options. But million square footers, there's one tenant for 1 million square foot buildings out there that have already been developed. So you're seeing a tale of two cities, if you will, based on just two different markets, but a 6-hour drive away.
Right. And so on the industrial side of things, I mean, you still have people with leases that are expiring, that are still in that 70, 80 cent a square foot range, that even at $1.25, they're looking at a 50% increase.
Sticker shock.
Right.
It's
still a sticker shock. Not as bad as before. I can live, but it's still all right to the bottom line, right? So you still have wages, pressure for wages going up, although that's eased. But then you have all the other just general inflation and gas prices and everything else. And then on top of it, your rent gets whacked in an upward fashion, and so your profit is impacted as a business owner, right to the bottom line.
Yeah, I think one way that we all should, as voters and as consumers, look at things is anything that impacts that supply chain. Anything that, from whether or not we tariff on the way in the door to where we say, look, you're an industrial building, you need to pay extra for infrastructure to distribution. All of that comes through the supply chain, and the person at the bottom is the consumer.
Yeah, it's all passed through. I mean,
as much as they can.
Right. And at some point you say, well, how much can the consumer take? And then the answer is, I don't know, but I have to keep passing it through, or I can't stay in business, right?
Well, you talk about the hourly wage, too. So, hey, I want $30 an hour. Okay, great. You can have $30 an hour, but guess what? Your Big Mac's now $29.
Right.
It's just how the supply chain works.
The $6 burger at Carl's Jr.
Fantastic.
It's a relic. It's a collector's item. It's now 16. But that is how it goes, right? And so you've seen what I'll call a softening and a leveling of the industrial demand, both on the leasing side and on the sales side. Because before, in the smaller buildings, call it 10 to 50,000 feet, people wanted to own it because it was such a hot commodity. Plus, the rent was so high, I could realistically own it for the same or even maybe a little bit less after tax than paying this ridiculous premium on the rent. Now you've come back to more of a leveling, and the problem is interest rates are still pretty high on the commercial side, and so it's not as attractive to buy, and so you've got demand down on the buy side.
That's correct. I agree. The one thing I will say is that the owner-user sales have still been, on both office and industrial, have been pretty decent because the SBA financing was still
Yes.
relatively affordable. Interest rates, while they went up so fast, just caused everybody to pause because you don't want to buy something and then realize that you're now stuck and the rate came down last month. It's not going to stop going up. It's going to stop going up, but it didn't.
Right. And also on commercial. I mean, people I talk to that don't understand the difference between financing on a residential, on your house. Like on your house, there's no prepayment penalty.
Yep.
And so you can go back next month or in 6 months and just refinance it. And so the pitch is, well, interest rates come down, you'll just refinance. Commercial, that's not how it works.
No, you're locked in.
Right. You're locked and there's a big penalty. And so there's cost to do that. And so I'm curious your thoughts as to where you think the markets will go from here. In that the promise is that rates will come down several more times over the course of the next 6 to 12 months, regardless of who wins the election. And so do you see people still waiting on the sidelines, waiting for the bottom or trying to get near the bottom? Or do you see people that then get off the fence and actually go make the deal?
Sure.
But then if you're locked in on the commercial side, you will have left money on the table. If your rate is 6 or 5.5 and it goes to 4 or 4.5, that's real money.
Yeah, the pressure is on on the money to figure out what it does. So if you are a commercial real estate company that has syndicated dollars or franchise dollars or collected dollars from somebody else, you have to place that. Otherwise, because you're paying a return on that.
Right.
So there's pressure on them to place it. So you will see some that's just their mantra. They have to go buy their real estate. But I think the key to everything is we just need to understand the rules of the game. So we've seen the interest rates going up, up, up. Now we're seeing them come down. The impression is that, okay, we've reached the top and we're now not going to see anything higher. So in my underwriting, I'm going to say that's as bad as it's going to get. Now let's look at how good it could get. So when we see rates coming down, we can say, okay, let's bake in our upside analysis,
Right.
saying that we're going to see some more rate decreases. But my downside is the ceiling that we had seen at 6.5%, maybe 7% interest rates. So once you know the rules of the game and where the finance market is, you can start playing in it. And people will come back and play in it once they understand what the rules are, what the sidelines are, what the ceilings and the floors are. So I anticipate seeing a much more active market. I think as we both are older and own real estate, we're going to start transitioning that real estate down to the next generation. So I think you're going to see a lot of that taking place. I do see people taking California money and buying in other states, just for the yield that they can get. So at my company, over the last 2 years, we've seen a steady increase in the volume of activity and the value of that activity. So by volume, we don't obviously as brokers, we don't get paid on the number of deals we do. We get paid on the value of those deals. But it's nice to see that the number of transactions are increasing, and that's single digit, about 5% each year now for the last couple of years. But the value of those transactions have gone up double digits. So you're seeing about a 12% increase in the value of those same transactions that you're seeing more of. So that's a positive sign that you're seeing more activity, more transactions taking place. But back to your point of, do you wait for the bottom of the market? You'll never be able to time the market, right?
No, and I think there's a certain segment of people that always try to do that. But I mean, a sophisticated investor would say, I'm getting 5 or 5.25 in the bank.
Yeah.
I need at least that to take it out of the bank and put it into a piece of real estate.
Absolutely, the risk factor, yeah.
And in Southern California in particular, very difficult to do, right? That's why you see people going to Tennessee and to Arizona and to Texas. And while you don't get the upside, you also don't get the downside, but you do get a better cash flow return. And so it's interesting to see how people think. But I think if people were getting 3% in the bank, then and they could get 4.5% on a real estate investment, there would be a compelling reason to put that money back in play.
I agree.
And it's not there yet. And you still have this inversion between the cap rate, which is in the 4s or less if it's multifamily or other things, and then you have to borrow still at 5s and 6s or whatever it winds up being. And so I'm just losing money on it. You better love that property.
Right.
Or there better be some
Some
big
serious
value,
appreciation
yeah,
coming.
some value add or something that you can do.
Yep.
But to just buy it and coupon clip or buy it and raise the rent some nominal amount of money, I don't know how that works for folks.
Well, and the other component too that you're seeing is foreign investment you think would come up.
Yeah.
Because you've seen a lot of Russian and Chinese buying residential and not occupying.
Right.
They're just parking their money. They're losing it day one.
Right.
They don't rent them.
And they don't care.
No, because it's safe.
Right.
It's a safe environment for them. So for us, we're looking at yields. They're looking at a place to squirrel away money so that they can come back and collect. But you were correct when you say having 3% in the bank. Remember it was 1.25.
Yeah, I remember
right?
it was zero. So
Exactly.
you had to spend the money.
Yeah.
You didn't have to, but I mean, there was no reason to keep money in the bank. Today,
right.
there's every reason to keep money.
Or a treasury. Yeah, 4.5. Okay, so what's my yield risk premium if I'm going to go buy a piece of real estate?
Buy a bond. I mean,
200, 300. So, but then it comes down to the product type and where we've seen the most aggressive activity and where those cap rates got lower. So industrial cap rates got into the threes. Apartments got into the threes. I even heard of a 2.8 in the apartment building. Office got down low, and now we've got the whole COVID occupancy issue with office. Retail never really, except for the single tenants, never really dropped. So a strip center was still a 6.5 kind of cap rate. And so you don't have that distressed owner because, okay, now you're back to a 6.5. Well, I never left it.
Yeah.
Whereas some of these others bought and now they've got a 3 or a 4. Hopefully they've got long-term debt, but if they don't,
there's an event, and so
there's an event.
You'll see more deals, I think, from leases rolling where tenants downsize and move out, and now I got an empty building, I got to figure out what to do.
Yep. Or
I've got debt that's rolling, and if the rates don't come down enough, I get caught, not necessarily with my pants down, but maybe partially.
Right. But the benefit, the hopeful benefit in some of this is banks don't want to foreclose. CMBS might, but a bank, let's say you've got a property, you're making your payments, and you just have a maturity, and I come to you and say, pay me off or I'm foreclosing. Well, if you declare bankruptcy, you're going to go to the bankruptcy court, and the judge is saying, well, wait a minute, bank. This guy's been paying his mortgage every month. He's doing great. The property seems to be okay. Tell you what, your new loan amount and your new interest rate and your new length of term is now extended, so you're going to get this crammed down. I think they'd rather come to you and say, tell you what, let's give it another year.
Right.
Let's just see how you do next year.
Yeah.
We're going to extend this thing out. Maybe give me some cash just to make me feel good.
But the borrower who has capacity to pay, but it just basically hurts him, right?
Sure.
It takes away all of his cash flow.
Good money after bad, or
the bank would say, hey, I'm sorry, man, you're a big boy. You bought this property. You're going to have to live with it until it gets really bad, like you say.
right.
And so,
And also until they have to have it hit their books.
Right.
That's the other. So there's a kind of a cat and mouse a little bit going on with some of this, where does the bank truly want to take things back, maybe take the hit to their books? Given everything going on, it's probably easier just to say, well, let's give you another year and see where this thing plays out.
yeah. And then on the flip side, you have operating expenses still going through the roof, whether it's utilities or trash or wages, or, and wages relate to management fees, and wages relate to maintenance, because it just all impacts it at the end of the day. And either that stuff is passed through the tenant, it's passed through one way or the other,
Right.
but anything that's absorbed by the owner, it just goes right to the bottom line.
Typically, they'll absorb as much as they can, but when it starts hurting them as
All right,
well,
so
it
I gotta
goes
pass
straight
it
on
through.
down. Yep.
So let's talk about the office sector for a little bit, because you touched on it. Office sector, everybody says struggling, but I say not. I mean, certainly struggling relative to industrial, but not struggling in every submarket, and not struggling in every city, and not struggling in every
Agreed.
type of building, right?
Absolutely.
And so while the common perception is, oh, office market's terrible, I should get a bunch of free rent, I should get a deal on my rent. The answer is, yeah, if you're out in the marketplace, you will make a much better deal than an industrial guy, and
Yeah.
you will make a much better deal than you would have pre-COVID. But it is all relative at the end of the day.
Completely
So
agree.
I'm curious if what the perception is and the reality of what you're seeing from landlords in terms of the dropping of the rent. Let's, I guess, touch on that, because I feel like the rents have adjusted to where they're at, and landlords not really excited to go much lower, because it impacts the value of the building.
Sure.
It'll impact their financing long term. I'd rather give you some goodies and get you in the space,
Right.
and
So I'm gonna
get a
keep my
good
face
tenant
rent high
and make sure I rent to a guy who can pay.
Exactly.
But I'm curious your thoughts on what you're saying.
You're correct. It is our market is always, it depends. It does vary by local markets. I'll pick on Los Angeles and I'll pick on San Diego, because I've got offices in both markets, the strong one and the weak one. So I'm in downtown Los Angeles right now. Tenants are evacuating. as quickly as possible. You're going to see a lot of goodies, as you mentioned, for a tenant to go to downtown LA. Century City is the opposite. You're paying $650 a foot. You've got tight. You've got all the amenities. That's a strong market. San Diego downtown. This is a shocker for me, but the Irvine Company just sold a building down there for about $85 a foot. Now, Irvine Company doesn't sell. What message are we supposed to take from that about downtown San Diego? Right, there's something there. But we're also up in Del Mar, and that's a very tight market where they've basically come back and said, you want to be here? You tell me what you're going to do for me as a landlord. So people are going for the amenities, the quality. I'm in a 4-story. It doesn't necessarily have to be a 4-story versus a 20-story. But it comes down to strong ownership. It comes down to the amenities that are in the building. And it comes down to probably how easy it is for my tenants to come to the building. So I've got buildings that are easy to access, that you don't have to go drive an hour. You don't have to get into BART or anything along those lines, that if it's easy to come to and you've got someplace they want to come, they'll show up. You're starting to see the employers get a little bit more control over the situation. Remember, supply demand, it was favoring the tenant or the employee. You're starting to see landlords
come back. I want you back in the office, right?
Amazon just said 5 days a week. It'd sure be nice though if the government led by example and said, no, you're in 5 days a week.
Right.
Come on in. But we haven't seen that yet. But yeah, we're seeing strong markets and weak markets, flight to quality. Landlords are buying tenants. They are trying to keep their face rate high only because that's their advertised price, and it's easier to negotiate from there than it is to start low.
Yeah, there's many reasons why you can't go below a certain threshold.
Sure.
And from a tenant's perspective, you can go to a lesser quality building and get a lower rate, or you could find a one-off landlord that really is truly desperate that might give away the farm. And then in those instances, you're going to make a deal. But if you're going to a well-heeled landlord that's trying to have some sense of reasonableness to how they're doing
and
it,
return for their fund or their investors.
Yeah,
exactly.
And so. And I find too that if you're looking for a bigger chunk of space, you certainly can command more concessions and a better argument. But I also find that the medical market, the quasi-medical, and then you still have some growth, I think, in the tech and the AI and software and some of these other industries, where you're starting to see people say, "Hey, I need more space," and that's not. I am in 2,000 feet. I need 10,000 feet, but that's I'm in 2,000 feet. I need 3,000 or 4,000 feet. There's inherent growth.
Yeah, well, it's fascinating too. So I was talking with an interior architect who basically said, if you're going to come to the office 2 days or less, you can change your square footage. You can go ahead and reduce that. If you're in 3 days or more, you're going to need the same level of square footage. So if the employer is saying 3 days or more, you're shrinking of the square footage just because they aren't coming into the office. Even if you say, I want you there 5 days or more. We have brokers. We can't tell them, hey, I want to see you in the office. So do you need all that square footage if you've got an office that they're occupying once a week or popping in, or do you want hotel space? So I think there's some dynamic where the use of the space is still in play, where we're trying to figure that out. And we don't know exactly where that is today.
Yeah, I agree.
I may have 30 employees that I only see 10 on a consistent basis. Do I need 10 and 3 hotel spots? Do I need 15? What is it that I need? And we're still trying to get our hands around that.
And you still have, I think, the knee-jerk reaction, which is, let's say my lease is up in 6 or 12 months. I'm trying to guess what the future holds, and if I'm going to sign a 5-year lease and things change down the road, I could be left with too little space, and then I'm in a pinch, right? So you've got to balance that, trying to save money and not have half my space sitting empty against being out of space, right? Exactly. So it's really is a catch-22. And then I think the other side of it is, I'm curious your thoughts, but there is no new office space getting built, right? So I believe inherently the office market will slowly come back. It will not come back with great strides tomorrow, but it has to come back as more people inherently grow, as more people come back to work. I don't think less people will go to work than where we sit today, and there's just no construction.
Yep. Well, I agree. It's the supply, right? When we talk about our supply demand. So
I learned that at UCLA. That was the one class I paid the most attention.
How about that? So I think you're going to see supply actually reducing. One, there's not going to be new construction unless it's for a specific tenant. You are seeing some in the medical and the government side of things, but you won't see new build. As the older gets older, it gets obsolete, it gets replaced. Yes. So you're starting to hear about, hey, we'll give you tax credits to go turn this into multifamily or do something else with it. You're eventually going to scrape it. So as the supply diminishes, demand stays the same or even increases, you're going to see more occupancy.
Yeah. And I think
just the
people
way it
look at
works.
downtown LA and go, well, you're not going to scrape a high rise and you've got an empty high rise with a bunch
Already.
of graffiti.
Yeah.
That does not apply to every other submarket
That's correct.
around the region.
That's correct.
It's an anomaly.
Yeah, but for me, it's also give me a reason to be in downtown LA right now. Before COVID, you had a great story. We're live, we're young, we're hip. We've got these entertainment venues, we've got all these condos and apartments, and I think just now they've kind of lost that story and are trying to find it again. San Francisco had the same. Seattle had the same. All their downtowns, all the social woes. Basically, people moved out. I don't want to go work there. I don't feel safe. Driving in sucks. Why would I want to be there? But I think right now San Francisco has stepped up their game and has started saying, look, we're going to make it safer for you to come in, more desirable for you to come in. And you're starting to see a little bit of a turn of the tide there because they've got a story. San Francisco is a destination place. It's got the ocean. It's got some history. Downtown LA, I think, still has to figure that out. San Diego is also still trying to figure things out, although I think they'll recover before downtown LA because they've got that desirability, the water nearby, strong residential, etc.
They're not at the bottom like downtown is as well.
I agree.
And it'd be interesting to see how the politicians, not to get too political with it, but I mean, I don't know. I'm no expert. The first thing I would do is make it safe so that people would come back, right? I mean, it seems to me like that ought to be top of the agenda. We'll see if that really is and see how that goes.
Safety, infrastructure, getting in and out, and the amenities. So it's also a little bit of the chicken or the egg because how does retail survive in a downtown environment? Because you've got the buildings that are occupied with people there, and when they're not there, there's nobody to buy their sandwiches or their goods, and so the retail goes out of business. And you really have to figure out what's going to come first, and I think it's going to be the infrastructure with some safety and letting people feel good that it's okay to come back into town and there's a reason to be there.
Yeah. And so what is your prognosis and what do you guys talk about and when you go meet with the different branches and the brokers in your various offices in terms of, I guess, game plan and look ahead for the next 12 months as far as the health of the market, the activity, and what do I do the same or different going forward?
Sure. So again, back to the brokerage, it's on transactions. So wherever people are moving, there's a transaction. So it's beneficial for us. So it's find somebody that needs to make a decision. Somebody has to make a decision at any given point. Sometimes there's winners, sometimes there's losers, sometimes there's shrinking square footage. But the benefit that I'm seeing right now is in the past we were doing 1-year lease extensions in the office market. I don't know yet. So just give me another year. We'll figure this out. Landlords grateful that they're still there at the same square footage would extend that. We're starting to see more long-term leases being signed.
Yeah, because I'm going to be talking. I'm going to blink and I'm going to talk to you again.
Yeah, exactly. So one of my tenant rep guys has signed 4 8-year leases in the last 3 months. So people have made those decisions. He said, and probably 2 of them will be looking for more square footage because they thought they would downsize appropriately. He goes, in about 6 months, my guess is we'll be looking for more space for them. But they're signing longer-term leases. They're making decisions.
They can
They've
see,
decided
right?
their game plan. And that's where the strength is. If you're a tenant, you have made a decision. This is what we're going to do. You're either back in 2, 3, 5, whatever it is, but we've made the decision. We're going to implement this decision. We're executing this decision. Yeah. And then they're out. And right now, I think they're making decent transactions based on historical values of these buildings. So you're getting a good rate. You're getting a lot of the freebies that come along with the free rent, the tenant improvement dollars. So you're making a commitment and you're getting a good value to go do that. You just need to decide, do you need that square footage for the next 5, 6, 7, 8 years? And if you're good with it, go for it. Yeah. Execute, and you're going to make a good transaction.
And those people, I think, long term, will look ahead 2, 3, 4 years from now and say that was a smart move.
Exactly right. I agree with you. Yep.
And so what impact do you think the election will have or won't on the commercial real estate markets? I mean, obviously, it is all dependent upon the overall economy, and you really have 2 different, I think, paths in terms of what winds up happening depending upon who wins, and it's a toss-up, right? I mean, California, not so much a toss-up, but the states that count, total toss-up.
Right. Well, I think what's fascinating is this year seems like a very commercial real estate focused year for legislation. We've become the piggy bank for all the social benefit programs, all these wealthy corporate real estate owners. Let's go find ways to get money from them. So there have been a lot of bills that impact. Some of them have been pushed back until next year. Some of them have moved forward. So there's 2 bills on the ballot in California right now, 33 and 34, which are about rent control. That will have a dramatic impact on anybody that owns multifamily. There's been some legislation that's passed that said we want to make sure your balconies and your
Right.
and your cantilevered overhangs are safe. So you're now going to spend a bunch of money on that. But by the way, you can't raise your rent to a certain level, and you can't stay within the market. So there's a couple bills that are related to that. I think Trump and Harris have similar opinions about what they're intending to do in the foreign markets with tariffs and things of that nature. But Harris's bill has already come out coming after 1031 exchange, trying to limit that. So that has a dramatic impact on us,
For sure.
and would definitely impact our transaction volume. So it comes up every year. It seems to have come up again, where they're coming after the 1031 exchange. Capital gains, they're trying to hit that. Corporate taxes, one wants up, one wants down.
Right.
All of this plays out to us as individuals as to what it's going to cost us at the end of the day. So while there are a lot of similarities between the two, I think there's going to be some dramatic impact to us as individuals if you don't read the bills and you don't look at the fine print of what they're actually saying and what they're intending to do.
And I think part of the issue, too, will be the proof will be in the pudding, because regardless of who wins, how quickly will you be able to enact the policies that you're talking about or thinking about, or will you get stymied by the House or the Senate, or just caught up with other things that wind up happening, right?
Well, I think most of
Or
our
so-
hopes
and
is
how
that they
much
do
it-
get stymied.
Right. And in certain respects, because I feel like as a business owner, and as someone who talks to and deals with business owners on a daily basis, for me, in our world, right, what's good for business will create a healthier economy, and vice versa. And therefore, it's better for the employees, it's better for the real estate, and it flows downhill. And so for me, however it goes, I just hope the economy is on an upward tick.
I agree.
And then
I
that
agree.
will trickle back down to the real estate markets at the end of the day.
And at the end of the day, I think it's more important for all of us that there is not a giga majority like we have here in California, that there is control of one group over one house and another group over the other house, because then they have to at least cooperate and try and make things palatable for everybody, versus controlled by one particular group, because then you get the policies that are really one-sided, don't get a chance to be negotiated and made tolerable for the rest of us. So I think stalemate is actually beneficial for all of us, because then we won't see some of these dramatic
I think
things
part of the
coming
issue
across
is the
table.
unknown, right? People cannot make decisions until they figure out what path you're going to head down.
What were the rules of the game? Exactly right.
So,
Exactly right.
Well, good. I appreciate you coming on and sharing your thoughts. We
Yeah.
could go all day,
Of
but
course.
we both got other stuff to do.
Exactly.
But always good to get your perspective on things, and
Yeah.
always good to see you. So much continued success to you and your business and your company and your family.
Thank you. I appreciate that. You
and-
as well.
Yes. And so before we go, I do want to do just a shout out that I forgot to mention at the beginning, which is our thoughts and prayers go out to all the people in the Southeast that were hit by the hurricane and that are struggling with that. It's just terrible stuff, and it's tough to watch it on the news, and I'm sure it's even more dramatic and traumatic for the people that are there. So with that said, I am Barry Saywitz. We will be back here next Tuesday talking more real estate. Thank you, Eric Paulsen. Thank you to everybody here at OC Talk Radio. Go to the website for the Evening for Autism, and we'll see you back here next week on Let's Talk Real Estate.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.